The warning signs are flashing, and the question that many hope to avoid has now moved to the center of national conversation. Are we in an economic bubble that's on the verge of bursting? This concern gained new momentum after ABC News spoke with Diane Swonk, the chief economist at KPMG, who offered one of the clearest, most grounded assessments of the U.S. economy heading into 2025. Swonk explained that the recent surge in stock prices, especially the strong rally seen last Friday, isn't just a reflection of optimism, but may also indicate that markets are reaching levels no longer supported by the underlying economic reality. She pointed out that valuations have been climbing faster than earnings and fundamentals, a classic signal that enthusiasm may be outpacing actual growth. On top of that, a key inflation report delivered an unexpected surprise, showing that prices remain stickier than expected. This matters because it pressures the Federal Reserve to maintain a tighter policy stance, giving them less room to support the economy if a downturn begins. Swonk emphasized that inflation's refusal to ease smoothly creates a complicated backdrop for both consumers and businesses. Rising costs can squeeze corporate profits, while households dealing with higher prices become more cautious in their spending. This slower consumer momentum can weaken the broader economy at the exact moment when markets are priced for perfection. Adding to the risk is the looming possibility of a U.S. government shutdown. Swonk underlined this as a significant but often underestimated threat. A shutdown would temporarily halt many government operations, delay important economic data, interrupt payments, and shake overall confidence, conditions that can quickly spill into financial markets. When markets are already stretched, even a relatively modest shock can act as a tipping point. She also highlighted that interest rates, although not rising at the moment, remain elevated compared to the last decade. Higher borrowing costs affect everything from mortgages to business loans, slowing momentum across multiple sectors. And because rates are already high, the Federal Reserve has less flexibility to cut aggressively if conditions worsen. This lack of policy cushion raises the stakes and increases the vulnerability of the economy if several stress points hit at once. However, Swonk made it clear that despite these risks, a bubble burst is not yet guaranteed. The United States still has real strengths working in its favor. The labor market, while cooling, continues to show resilience. Job growth may not be explosive, but it remains steady enough to support consumer activity. Corporate earnings, though pressured, have not collapsed, and in many sectors continue to meet or exceed expectations. These stabilizing forces act as buffers, giving the economy room to adjust without immediately falling into crisis. Global demand for U.S. assets also provides support, helping keep markets from reacting too sharply. Still, Swonk stressed that this balance is delicate, and the coming months will be crucial. A sharp jump in inflation, a deeper than expected slowdown in consumer spending, or a prolonged government shutdown could shift conditions quickly. Market psychology is another factor. When investors grow too confident during a rally, they sometimes overlook hidden weaknesses until it's too late. This buildup of complacency is a common feature of bubbles, and Swonk suggests that some of that sentiment may already be in play. For people watching the economy, investors, workers, business owners, or content creators, the takeaway is that the U.S. is in a moment that demands attention. The ingredients of a bubble are present, but whether they ignite depends on how these pressures unfold. The most important indicators to watch include inflation data, Federal Reserve guidance, corporate earnings trends, government budget negotiations, and the overall tone of investor sentiment. If several of these begin to shift in the wrong direction at the same time, the risk of a sharp correction grows. But if inflation cools, earnings remain steady, and political disruptions are avoided, the economy may navigate through this period without a dramatic break. As Swonk described it, the U.S. is not standing on the edge of guaranteed disaster, but it is standing closer to the edge than many realize. This is a critical moment to stay informed, grounded, and prepared, because the next steps the economy takes could define the financial landscape of 2025 and beyond.